All right, let's dive right in. Today, we're going to be accounting detectives, solving one of the biggest mysteries in business. When a company spends money, what does that spending actually mean for its health? It's a puzzle, so let's grab our magnifying glass and get started. So, picture this. Your company just spent $100,000. Is that good news? Bad news? Should you be celebrating? Or, maybe updating your resume? Well, the truth is, you can't possibly know the answer, not without knowing how that money was spent. And the secret to unlocking that answer? It all comes down to one simple rule. And that secret is the 1-year test. In the world of accounting, the huge difference between all types of spending really just boils down to time. Specifically, how long is the business going to benefit from that spending? If you get this one decision wrong, you could be telling a completely false story about your company's health. It literally separates every expense into two critical categories. First up, we've got what's called capital expenditure, or CapEx for short. This is the money you spend on the big stuff, the major items that are going to provide value for a long, long time. Think buying a new building, a big piece of machinery, or a delivery truck. It's really an investment that's going to help your business make money for years to come. And on the flip side, you have revenue expenditure. Now, these are the everyday costs of just keeping the lights on. These are the expenses whose benefits get used up pretty much within the year. It's the money you have to spend simply to maintain your business as it is, paying salaries, utility bills, and making minor repairs. So here's where the difference really becomes crystal clear. Capital expenditure is all about building for the future. Its benefits last more than a year, and it actually increases your ability to earn. Revenue expenditure, that's for the here and now. Its benefits are short-term, and it just maintains what you've already got. So buying a brand new machine is capital. Paying to fix a broken part on that same machine is revenue. Simple, right? Well, not always. You see, in the real world, that line between the two can get pretty blurry. So every good accounting detective needs a toolkit. And for us, that toolkit is a set of 5 key clues, 5 questions you can ask to classify pretty much any expense you come across. Okay, so here's our toolkit. First, we ask about the nature of the business itself. Then, is this a cost you pay over and over again, or is it a one-off thing? What was the real purpose? Were you just maintaining something or giving it a major upgrade? And what about its effect on revenue? And finally, materiality. I mean, a $10 stapler might last for years, but the amount is so small, it's just not worth tracking as a long-term asset. If you ask these 5 questions, you'll almost always get to the right answer. All right, detective, you've got the toolkit, so let's crack open a few case files and put those skills to the test. I'm going to give you a scenario, and you decide, is it capital or is it revenue? First case is up. You have to pay a lawyer a hefty fee to defend your company in a lawsuit. Someone is challenging your ownership of the land your factory is on. So that lawyer's fee, is it a capital expense or a revenue expense? Go ahead, take a second. It's revenue. And why? Because you're not buying a new asset. You're not increasing the factory's capacity. You're just paying to protect and maintain what you already own. It's a maintenance cost, plain and simple. Okay, case number 2. This one's a little trickier. You're building a brand new movie theater. But to do that, you first have to build some temporary huts on the site to store materials and for workers. These huts are going to be torn down as soon as the cinema is finished. So what about the cost of those temporary huts? That's capital. I know, it feels weird because they're temporary, right? But here's the thing. Their cost is a necessary and direct part of constructing the main long-term asset, the cinema. So their cost just gets rolled into the total capital cost of the building itself. All right, last case for this round. You spend $25,000 to completely overhaul a car's engine. Now, the goal isn't just to get it running again. The goal is to significantly improve its fuel efficiency, which is going to save you a ton of money for years to come. So, capital or revenue? And that's capital. The key word here is improvement. You're not just maintaining the engine, you're fundamentally upgrading it in a way that provides a long-term financial benefit by cutting down your future costs. That is a classic capital expenditure. Now, this next slide is just a brilliant example of probably the most important clue of all, the nature of the business. Check this out. A company that sells computers buys 20 of them. For them, that's a revenue expense. Why? Because those computers are just their inventory. They're goods meant to be sold right away. But when that same company buys one more computer for its accountant to use for the next 5 years, that's a capital expense. The exact same item, 2 totally different classifications.
all because of context. So we've pretty much mastered money going out. But what about the other side of the coin? What about money coming in? Well, the great news is the exact same detective logic we just learned applies to receipts too. It's really simple. A revenue receipt is money you get from your normal day-to-day business, selling your products or services. A capital receipt, on the other hand, comes from something outside of your normal operations, like selling off a big long-term asset or maybe an owner investing more cash into the company. Here's a perfect example to make it stick. Let's say you sell an old machine for $12,000. That entire 12 grand you just got is a capital receipt because selling off your heavy equipment isn't your normal business. Now, let's say that machine's value on your books was only $10,000. In that case, only the $2,000 profit you made is considered revenue. So at this point, you might be thinking, okay, this is interesting, but why does this distinction actually matter so much? Well, it matters because how you classify these things determines the entire story your financial statements tell the world about your business.
And here is the real bottom line. Every single revenue item we've talked about, both money in and money out, goes onto something called the profit and loss account. That statement tells you how profitable your business was this year. But all of your capital items, they land on the balance sheet. And that tells a different story, not about this year's profit, but about the long-term financial health and the total value of your company. Ultimately, it all comes down to this single purpose. Making that distinction between revenue and capital is the absolute foundational step. If you misclassify your spending, you're not just making some small clerical error. You're fundamentally telling the wrong story about your company's performance and its real value. So the next time you see a headline about a company making some huge expenditure, you'll have the detective skills to look a little deeper. You can ask the most important question: are they investing in their future and building for long-term growth? Or are they just paying the bills for today? The answer to that one question, well, it tells you everything you need to know. Thanks for joining me.